And thank you all for being here. And of course, all distinguished, all with a point of view on this subject. So I'm going to start in a place where there will be a fair amount of intersection, I imagine, but also it'll help sort of position where you sit and how you're seeing the world. I am going to start with you, Doug, just because you're down at the end there. And that is just quite simply, when you kind of survey the landscape, and in the context, obviously the overarching theme is sort of the cross-border, but the biggest economic risk you see out there right now, or risks if you prefer not to oversimplify down to one, but when you think about kind of fragility versus strength in the economy, what's on your mind?
So I'm going to start short-term, easy stuff. I still think that inflation is our biggest concern. So many people in the room probably haven't ever dealt with serious inflation. We've all had a taste of it. I would just point out that gasoline prices are actually lower than they were a year ago. Home prices are lower than they were a year ago. And yet here we are with still 5% inflation in Canada and 6% inflation in the US. It's real. I'm a little bit concerned that we might take our eye off the ball because it has come off of the peaks. And I think even the OPEC agreement yesterday to cut production is just a reminder that inflation hasn't gone away and that the job isn't done. If I think a little bit longer term and look out a bit more, I think one of the most important statistics that we've seen in quite some time in Canada was that our population grew by 1 million people last year. Now, admittingly, there were some special factors there, but if we look at it bigger picture, Canada's population has grown by about 1.5% per year in the 3 years going back to just before COVID. That is absolutely the opposite of what's happening in the US. The US is actually seeing the slowest population growth that we've seen in a century. It's actually below 0.5% per year. That's a very different world than we were living in the 3 decades prior, where Canada and the US population growth was almost identical. Now, unfortunately, the flip side of that is, yes, we've had this very strong population growth, but we've had no productivity growth since the start of the pandemic, unless you think that's some kind of pandemic oddity that we really shouldn't look at. U.S. productivity growth has actually been perfectly normal on average over the last 3 years. It's right back to the trend it was before. So if we're talking about bigger picture concerns, I am concerned about Canada's very weak productivity performance, and I'm sure we'll get more into that.
Absolutely. Randy, what's top of mind for you?
I would say maybe just a little different perspective. I actually don't think that inflation is the biggest risk, because I think that the central banks, both in the United States and Canada, will get on top of inflation. They know how to do that. This is the sort of inflation that is actually tailor-made for control by central banks. The tools they have can constrain demand, certainly in the United States, I think maybe to a lesser extent, but in Canada as well. This has principally been a overstimulated demand-driven inflation, and so the Fed can respond to that and control that. They've demonstrated that they will, and as Douglas mentioned, we're beginning to see the results of that. Inflation is significantly down from where it was a year ago. Still a long ways to go, but that will happen. The biggest risk, I think, is a misjudgment in the strength of the medicine in order to get that to happen. And therefore the risk that the recession that's probably inevitable in the United States is not short and shallow, as I still believe that it's likely to be, but is not as short or as shallow as it might have been, because of the difficulty in judging exactly how much to constrain the economy. There are a few reasons that it's particularly difficult now. One, given the very, very low interest rate environment in which this tightening cycle began. We've never had a tightening cycle begin from such a low level. And as a consequence, the cost of short-term debt service has been increased in the United States by 20 times. I mean, that's never happened before. And so the Fed has realized that some of the general central banking rules, like the Taylor rule that some of you will be familiar with, and general rules that have said, here's how much you need to raise interest rates to constrain inflation at a particular level, are not going to apply in this environment, because you're increasing the cost of debt service by a much bigger percentage level for a given nominal increase in interest rates than you have in the past. And therefore, since there aren't precedents for this, it's difficult to precisely calibrate what the effects of your policy are going to be. while I sat on the FOMC, which is the Monetary Policy Making Committee in the United States, I was probably the biggest hawk on the committee. I took a little pride in that. But even I would say that the level of interest rates in the United States has probably already exceeded what was necessary to constrain this inflation. And because of the lags with which monetary policy acts, you just can't tell whether you have done too much yet or not. It used to be the case that economists thought that it would take 1 to 2 years after you've changed monetary policy for the effects of that to really flow through the economy. Almost everyone believes that's a shorter period now, but we don't know how much shorter. So the Fed is thinking that it's probably about 6 months now because of improvements in communication, a variety of reasons that lag is shorter. But if 6 months have passed and inflation isn't responding as you wanted, is that because you haven't done enough? Or is it because you've already done too much and it's just going to take longer to flow through the economy and you've misjudged what that lag is? So because of the degree of difficulty of all of this, I think that the risk is that the recession that's engendered by monetary policy is deeper and longer than it would need to be, and that's just a very difficult thing to calculate.
Dan?
So to dovetail off of what Randy said, I think, and Doug, I think it's really important to understand, first of all, where is monetary policy affecting the economy the most in the United States? And the Kansas City Fed just came out with a study saying that in the service sector where inflation has been the most persistent and where the Fed is worried the most about it getting sticky is the least sensitive in the labor market to interest rate hikes. And so the risk that the Fed does exactly what Randy says and overshoots and goes too far and doesn't calibrate is quite high. And I think if you also layer on top of this that the Fed has decided to delineate and divorce the idea of financial stability from fighting inflation in terms of rate hikes, I think that's, one, not really compatible. I think they are linked to each other, but in their desire to continue to fight inflation and not acknowledging the pipeline of, they have to some extent, but not as much as I would like, the pipeline of credit tightening that we have in the system today as a result of the last several weeks in particular, that hits the backbone of the labor market. We saw the job opening and labor turnover data today, and it slipped below 10 million, still well above the 7 million we had new job openings in February of 2020. However, jobs in the companies over 5,000 employees have been declining, those job openings. More than 4 in 5 new job openings are coming from firms with less than 250 employees. And you're now going to tighten the credit conditions specifically for those companies quite dramatically. And so I do worry, very much like Randy does, that we'll get a deeper recession, not the shallow, sort of mild. I have actually heard people refer to it as a garden variety recession. I've seen a lot of recessions, and there's nothing garden about them. It's more like a jungle. But I think that's really important to understand because every recession is unique. And I also think that we need to sort of introduce into the equation the tail on this particular recession. And that tail is not completely dissimilar to something we saw in the early 90s, and that is the commercial real estate and the loss of leases picking up. We've got about $500 billion in leases that are going to turn over in the United States that happen to be on balance sheets of companies that are going to tighten credit on top of it. And so you add that tail on to it, and I worry about our ability on the other side, even though I think we're in a much more structurally inflation-prone world than the world in which we left prior to the crisis.
A lot to chew on there. Bill?
Well, thanks. As a former politician, you'll expect me not necessarily to answer your question.
Not former, reformed.
Yeah, there you go, reformed. No, but I wanted to start just by reflecting on the poll that was just put up there, the 30% of people in this room that thought that it was a good idea to renegotiate NAFTA. As somebody who was there in office at the time when that came across the transom, we certainly didn't think that it was a great idea to have to renegotiate NAFTA. That said, we learned some things through that process, and I think I want to just mention the most important thing I think we learned during that process as Canadians, and that was that we needed to be out in front with our American friends, colleagues, partners, every single day. We realized that that was the only path for us to be successful in a cross-border relationship. So I say that because we were successful in doing that. We were collectively successful in doing that. And I think it's something important for at least me to start with today, because this session today, I just want to say to Bank of Montreal and to Eurasia Group, we need to be doing this as often as we can. We need to be individually with our companies, with our trade associations, with our leading groups, the business groups, both in the United States and in Canada. We need to be actively on this agenda, because there's going to be challenges that we're going to need to face together. And that to me is a really, really important learning. And for us in Canada, to come back to the worry around what's the biggest economic challenge, I do think that in Canada we have a bigger challenge, and what I'm most worried about is growth, is productivity growth. That to me is the biggest thing. We don't want to wake up in a generation and not have our children want to live in Canada, because the opportunities right down the street with our great friends in the United States are greater, because that differential in growth rates has been something that lures people to the United States. That's the challenge that we're facing as a country right now. We know the numbers. We know that we in Canada are investing less per capita than the United States is. And Americans would be astounded, but it's significantly less. We're in Canada investing about 60 cents on the dollar towards productivity improvements versus the United States. We're investing about 60 cents on the dollar on R&D versus the United States. So it's a real challenge that we face. So I worry most about that. I worry about productivity growth, and that's a short-term, a medium-term, and a long-term issue. And all the immediate challenges, they're real, but that longer-term challenge, if we don't get at it, the long-term comes pretty soon.
Yeah, and unfortunately, productivity has been a problem in Canada for 45, 50 years now. So it's also one that we have not managed to figure out.
And it's not a partisan issue. This is systematically, we in this country have created an environment where it's not as attractive for people to invest as it needs to be.
Tom, Ambassador Hillman earlier talked about creating those networks that create stickiness between our two nations. It gets to kind of where you live at that level of business to business and the organization that we can reach out. What's on your mind?
Two things. First, Bill, the grass is always greener, you know. And while a lot of the young people here might be thinking about going down and working for companies, the same company they could work for here, there are a lot of people in the United States with problems that they have in education, in crime, drugs, and other issues and these are all affect productivity. They all affect economic growth. Are thinking maybe we ought to get a house in Canada.
I've got two kids looking at it right now. Sorry about that. I'm not sure you want them or not.
That. But the point I'd like to make, in the previous session, this session, we've talked about the numbers. We've talked about the technology. We talked about the demand for minerals. The thing we really have to talk about in both countries, although Canada is leading, is we've got to do something in the United States about an absolute serious lack of human talent. Now, Canada has stepped forward, and some of the terms they use were a little different, but they're figuring out how to attract the right kind of immigrants from near and far. They're figuring out how they will integrate those people into their economy. Now, there's a lot of thinking about that in the United States, but the political circumstances right now are such that it takes a lot of courage to talk about immigration. I'm involved with a group of people, and the Chamber and others are all looking at immigration. How do you do it? You know, one way is to say, well, we got two parts of immigration. In the United States, we're not allowed to use all of the legal immigration slots that are available under the law. sort of game playing. If we went back and took all the slots we didn't use for 3 years and then look forward, we could go get a lot of people we need. Who do we need? You have to think about the fundamental function of not only the economy, but the society. Mm-hmm. We have a shortage of nurses that if we go back to another pandemic, not even this serious, we'll probably close a third of the hospitals in the United States, and in places where they don't have them. Second, when you start looking into the shortage of nurses, you get smart enough because they walk in the same places. We have a very significant shortage of fundamental doctor-to-patient care, the internists, the people that are needed to run our health systems. And you can go and look at where do we get the teachers we need? What are we going to do about people we need for manufacturing? Not only the people, everybody's talking about what we're doing in putting together factories to replace what we have lost from others that make what we need for all the cars and trucks we make here and there. And we're building $2 and $3 billion plants to do this. And you can find people on the lower level you can teach to do the work, but you can't find people that'll manage it or people to run the factories. The fundamental issue about improving your productivity, and you're working on it, and making things work better in the United States is to face up to immigration, go out and get the best people we can. And by the way, we have a little history on doing this.
You do.
It goes all the way back to who the hell we are.
Yep.
And we have got to stand up and go do it. Otherwise, we'll have all the smart things you guys are all talking about and nobody to do it.
So this is you're speaking a little bit to the choir in this room, but this gets at so the labor market is obviously a huge issue, both sides of the border, similar issues, but different issues. Doug, I want to make a suggestion, and that is we're filling gaps with immigration in Canada. It's part of our stated goal is to fill gaps, import the talent we need. Once they get here, we don't do as good a job as we could of actually getting them through regulatory burdens and into jobs, but anyway, we're getting them here. Are we squandering an opportunity to actually spur Canada to better productivity? And that's because that's not with bodies, that's with investment in technology. And a labor shortage is a painful dislocation that could get us there. Lots of new technologies coming our way. Are we filling jobs that we actually would be better off encouraging companies to invest around?
Possibly.
Not a popular view.
Possibly, but I'd like to believe you can do both. There have been episodes in our history where we've had very strong population growth and strong productivity growth, so I don't think it's an either or. They can somewhat work at cross purposes, perhaps in some sectors. By the way, I just want to go back quickly to a point that Tom raised, and I think it's worth hitting on because there was a lot of negativity around the Inflation Reduction Act earlier. I would just say I'm not a pessimist on that front because I think the constraint on the U.S. is on the labor side. I mean, where are we going to get the skilled workers in the years ahead? I think we are going to have a lot of spillover benefits in Canada and Mexico from that. But just going back to your point, no, as I said, perhaps in some sectors we wouldn't get the productivity where we would have otherwise had it. But again, I think the most important point is it's not an either or.
One of the big shifts, Bill, do you have to jump in?
I'm happy to.
Okay, one of the big shifts that we're living through, and Randy, I like your optimism around that banks will that there's a risk they won't land this, but that at least that they have the right tools for this particular inflation fight. I think you get a debate in some quarters on that, but I think I'm happy to hear you're optimistic. The problem we have, of course, is that this is a generational shift in rates, and where the framework that we've all been living in has shifted. And Silicon Valley Bank is a perfect example of that. And now we could Monday morning quarterback that and say the Fed could have looked down the road only by a few weeks and said we need a banking facility in place before a regional bank goes under, but it's in place now, so good for them. But the shift that's required as we reprice our assets, as we rethink where our returns may come, is going to affect businesses, it's going to affect governments. It already is something that we're working through. Are we prepared for that challenge? Because there's still a temptation for people to think this is a short-term, that the Fed and the Bank of Canada will get us back to status quo and all will be well. We may be settling in at a new normal here.
Yeah, I think that I'm probably about 85% convinced by the thesis that many of you, are probably familiar with, that that over the course of the last, call it 30 years, the United States and advanced financial economies in general have been able to run sort of relatively hot economies without inflation, in significant part because of the integration over those decades of a lot of new additions to a globalizing workforce. So first you had the integration of Eastern Europe in the 1990s, and no sooner was that complete than you had the integration of China in the 2000s, and the effect of that was to sort of constrain inflation and therefore constrain the level of interest rates that would be required to contain that inflation as a matter of monetary policy over the course of 20 or 30 years, which is why you could have such a dynamic economy leading up into COVID in the United States, an unemployment rate that was 3.5%, the lowest in 50 years, much lower than anyone believed was consistent with no inflation, and still have no inflation. There's a theory that I say I'm probably 85% convinced by, which is that the next 10, 20 years will be different because A, you're living in a less globalizing and possibly less globalized world, and the integration of that significant workforce has largely been completed. So where's, there's potential, there's a potential new pool of integrating labor from Africa, but that doesn't seem to be happening. And in any event, it will be happening in a much less globalizing world than was the case over the last 30 years. The effect of that would be to say, well, the same sorts of interest rate policies that were consistent with very low inflation over that period won't be going forward, and we might be going back to a world, therefore, where 4% short-term rates are not only normal, but on the low end. And that is a much different world than we have been living in for 20 years. And many people have sort of optimized their positions, their financial positions, expecting those very low interest rates to maintain. And when they don't, even for a short period, we see events like Silicon Valley Bank. And we will see more events in the financial sector. Not clear where they will come. They'll probably come from outside the banking sector, but that's sort of, even over a short term, that will result in pressures in the financial sector. But broader pressures across the economy, if those higher levels of short-term interest rates maintain because of this dynamic that we're talking about over a much longer period, call it 10 or 20 years, that's just a much different world than many people have grown up their entire lives in the economy currently.
Yep. Anyone else? Bill?
Yeah, I mean, look, I just want to crowd in and agree with Randy. If we think about what's led to the low inflation era, we think about these four factors. We think about aging of population. We think about rising inequality. We think about China and all that money entering into the global economy. And obviously, we think about globalization. And at least two of those now are under threat. I mean, I think the deceleration will maybe be slower than people expect, and figures are certainly proving that out, but it's real nonetheless. So that higher sustained inflation rate feels more like a probability than a possibility. I guess one thing I'd be interested, Randy, in your point of view and the other panelists' point of view is, will there be a difference between Canada and the United States? Because the United States has another factor, which is this banking sector, which has been proved to be I'll be kind, less resilient maybe than the Canadian one. So we have a particularly effective banking sector here, I would argue, and it's highly regulated and pretty concentrated, which has some pros and cons, but a big pro is stability. And as the US gets at that, as it deals with that issue and creates credit crunches, does that mean there's going to be a separation between Canada and the US that might emerge?
Not wanting to get too much into certain sectors, given my position, but agreeing with, there's a large issue out here. There's two issues. One is from February 2020 to February 2023, the US labor market grew by 1.8 million people. It was down by 300,000 if you do not include foreign workers that have come in with the benchmark revisions since January. And with that, we saw an increase in the participation rate as well. And many firms, most notably the firms that we survey in the US side of KPMG, are saying they still want to invest in labor-saving technologies, getting to some of the productivity issues we're talking about. And if I believe some people in AI, it will destroy 10% of people who develop the AI believe it will destroy the human race. I'm going to knock them out and stay with the other 90% because I don't want to be destroyed. But I do think it's really important to understand that these companies that want to invest in labor-saving technologies, which is productivity enhancing, it's only productivity enhancing, first of all, if you not just substitute capital for labor, but if you bridge skills gaps. That's where the tire meets the road. But two, and it gets to where the fragilities in our financial system are, and that is in these very companies that want to make these investments are now finding more of a credit crunch, which could undermine our productivity growth more in the United States than we had expected. And even though Doug says, well, we're doing great compared to the 2010s, we're up to 1%, that was subpar productivity growth for us in the United States. And so we're still very low, and then we've got a slowing population situation, the immigration issue, but then you sort of weave into it, are we going to get the productivity growth that we need, that we thought we were going to invest in, given some of the fragilities that we have in our financial system today? And I do think there's some short-term problems that could have some long tail events to it.
Yeah, I think that your concept of the long tail of the credit tightening period is an important one, especially for the business community and for policymakers to really kind of try to forecast out. Thinking long term can, of course, be difficult for policymakers sometimes. Sort of in that vein, I'm going to take a very kind of Canadian lens, and I'm aware that I've got 3 Americans here and 2 Canadians, but you think about the world and our relationship. Canada is long accustomed to importing policy. We do have to deal with what America does and respond often. This happens to be a time in our history where it feels like it looms large. So our banking system can be as robust as we like, and we still have to run stories asking, are your deposits safe at BMO, which is ridiculous. Yes. Daryl's vouching for everybody in this room, at least. But so we import this sort of sense of vulnerability in the banking system because if the US banking system fails, the entire world is affected one way or another. We're importing the Inflation Reduction Act and all of its attendant policies, which is a very different approach than Canada was taking for the last 7 or 8 years. But here we are, we'll respond. So Doug, I'm going to start with you. What are the policies Canada should pursue in sort of the context of these big forces that we face? In other words, we have a productivity problem. We're pursuing our own immigration agenda. We're going for a price on carbon, not the degree of subsidies, although we're doing some subsidies. How should we respond in the context of these massive forces we're facing?
Easy question. No, first of all, just stepping back very, very quickly, and just to reinforce your point, we can have the healthiest banking system in the world, and in the 4 quarters after Lehman Brothers went down, we actually contracted more than the US did through an episode when we had a very healthy banking system. So just to your point, we can get everything right and still be pulled under by forces from abroad. Look, even when you think of something like inflation or budget deficits, I think our goal here should be to be the best we can be. Like basically stick to our knitting, aim for the best, most successful policies we can do, and just control what you can control, I guess. Is what I think we've all learned, and even if that just means being a little bit better at the margins, so be it. I think that's what we should aim to do. And we've actually had one of the lower inflation rates in the world in the last 12 months when we compare ourselves to Europe or the U.S. or even Australia. We've done what we could do on that front. The Bank of Canada was one of the first ones out there tightening aggressively and unwinding QE, and I think that was the right thing to do.
Bill?
Well, I guess I could turn the question and say I think there will be some Canadian policy that Americans will inevitably adopt, not maybe looking at us necessarily, but I think in terms of the banking sector, to be specific, I think the trend is likely to be more towards where Canada is than where the United States has been. That's a prediction. I do think, though, in Canada, we have to take the approach that Doug said, and that is that we should think about our own situation and carefully figure out what we can adopt and what we can't adopt. And so there are clearly some things that we need to be careful about. We have to be careful about being specific with our particular, investment tax credits or production tax credits, and think that we can compete toe-to-toe with Americans on the same sort of topic areas. So that's a question we have to ask. I think we have to then think about the places where we can take quite a different approach. And I think the government, with the Canada Growth Fund that they put in place for the Americans here, a policy of putting some money aside that can specifically deal with opportunities and challenges. If we put carbon contracts for difference, sort of guarantees against carbon pricing, that might actually unleash some opportunities here that are unique to Canada. So we can take specific Canadian approaches that will make a really big difference in our long-term opportunities, and then carefully decide where we compete. And I think one of our continuing challenges, and I was always part of this too, so I can't say that that's something that is just being done now, is spreading ourselves too thin against too many different levers. And I think that's a challenge that we have to face up to.
And of course, Randy, we do import monetary policy, whether we like it or not. From your perspective, is that ever on the minds of the Fed, that the impact and influence of your policy on your near neighbor?
No.
I knew he was going to say that. I was just waiting for the no. I knew I was going to say that.
We knew it. We knew it all along.
Well, except to the extent that obviously the effective monetary policy on the entire environment feeds into what the effective monetary policy will be in the United States. And so, in looking at the overall global economy, of which the U.S. is a part, you take that into account. But it is, but it's a pretty rigorous practice at the Fed to focus only on the statutory mandates that the Fed has given, which is maximum employment in the United States and low and stable inflation. And there are many ancillary effects of monetary policy that people have said, shouldn't the Fed take this into account, or don't they take this into account? Whether it's the international consequences of monetary policy or within the United States, the effects on equity markets, for example, and the so-called Fed put, that if the equity markets fall too fast, the Fed will take care of that. And the Fed doesn't really target any of that.
Right.
They analyze it, but for example, in all the time that I was on the FOMC, I don't think anybody even mentioned the stock market, and the stock market in the United States believes that the Fed cares a lot about it and has its back.
Yeah. We don't have a ton of time, and I want to shift to the policy side. You went there, Tom, with immigration, and that is really because when business and government meet, as is so important at an event like this, but you wish it happened more often in the day-to-day sort of recourse of all of these things. Businesses really don't often stop and think of it. They're trying to get things done, right? They're trying to keep things moving and grow their own business, and they've got their own. But if you stopped a CEO and said, what's sort of the policy you wish were being pursued here, they probably would have an answer. They might have a few answers. So I do want to ask that question of if you could say to governments, focus on X. Is it immigration for you? Is it the labor market?
I think there are a number of issues, but we heard in a number of the earliest sessions the whole question of how you get anything done working with the government until you can get through the legal process of a permit or a contract or an arrangement, which some regulation of that is very important so that it's not all running down the street 100 miles an hour. But one of the problems is, a lot of the people that work in the federal government haven't come back to work yet. They're still working from home. And I don't think they're getting a lot of these issues taken care of. Fortunately, the Chamber of Commerce of the United States runs one of the most significant and effective law firms in the country, particularly on correcting the errors of government on matters such as how they're implementing the law. When you get past that, then you can start to look at what are the things you really want to get done. Mm-hmm. Because we walk around and we say, we have to do this, we have to do that. Can we? It's, your mother always used to tell you, may I and can I? And when you get that straight, we need to do something about the whole issue of the relationship in the particular area of the making it legal to do what we all have to do.
What we call red tape and regulations.
Yeah, that's right.
Bill?
Well, I guess first of all, as people all know in this room, being in government is hard. There's hard decisions that you have to take, and that there's immediate challenges. Social media is making it harder every single day. And so focusing on the long term is the particular issue that governments face. It's inevitable that you're going to get overwhelmed by every single challenge that you face. So it seems to me that I wouldn't advocate for a particular policy. I would just come back to that theme of growth has to be foremost in the minds of policymakers. It's hard to continue that approach, but it has to be on the basis of every single decision that's taken, some of which will not be related to growth, but many of them will. You need to be doing the analysis up front to say, what is the impact of this particular policy, whether it's a decision on immigration, which has short-term challenges and long-term huge advantages, or permitting, which has very difficult issues, but the lack of certainty is a real problem. You need to be thinking about growth as a frame of reference to start with, and that requires a level of discipline. It may also require thinking about different ways of coming up with policy, because coming up with policy with business and government, and in our country, provincial governments together is more likely to create enduring opportunities, because that will focus on the right things. But that's, those are changes in institutions that are difficult, but I think necessary.
Diane?
So going a little more micro and thinking about human capital and dovetailing off something you just said, getting provincial governments to work together, I kind of wish some of the states in the United States would talk to each other like this, in this kind of format, because we're getting a very fragmented system in the United States. And not only did the pandemic set back a lot of educational attainment, particularly among men, but also among underrepresented minorities. They stayed online in their neighborhoods longer than students that were in predominantly white neighborhoods. And it was cheaper to stay online. They actually saved money. And all the funding on educational is done at a local level on real estate tax revenues in the United States. And we've had a degradation of educational attainment in the United States. Women are far exceeding men in educational attainment, and the pandemic accelerated that. And this is not a zero-sum game. We need all hands on deck, and we're leaving so much talent on the sidelines. And it's always addressed at the federal level. Oh, well, reform education. It's not done at the federal level. We need to coordinate better across state lines. A lot of issues that are done regulatory across state lines as well. And that fragmented system I worry about in the United States starting to undermine a lot of our potential to grow and our potential to generate productivity growth going forward as well.
We aren't very good at doing hard things these days. No. Randy?
Well, let me just say, with respect to Bill's question on the banking system that's kind of remained, that I haven't at least responded to yet. I think, the Canadian banking system has been a source of stability for, in a number of periods of stress over the course of the last, even longer, when in the savings and loan crisis in the United States from 35, 40 years ago, that didn't propagate into Canada because of its much different banking system, and it was much more stable. there is a benefit to the U.S. system that comes with that cost of instability, which is that you do have thousands of small banks that are willing to make individualized, sort of somewhat riskier credit decisions, than the very large Canadian banks are want to do that can support dynamism. So the challenge that will, I think, face both Canada and the United States in thinking through what are the lessons from Silicon Valley Bank is, so is that balance between stability and dynamism, and each side seeking to improve the way that they have struck that balance.
Yeah, it's obviously an interesting point. And in this case, as in previous cases, if the regulations as they exist had been enforced, we might not be where we were. It's not that the regulations
that's certainly true.
don't
Let the
exist.
record show it was nothing I did.
No, it's not Randy's fault.
But I think it's a really important point that Randy brings up, because there is, in Canada, there's a real question about our dynamism, our ability to actually have that growth that comes out, and there are multiple factors at play. I think presenting us with the challenge of the the stability of our system and the compromises that brings, we should at least think about it. I get to the conclusion that the advantage here has been significant, and it's also been quite significant if you think about it for less advantaged Canadians that haven't gone through as many of the ups and downs. But there are certainly also challenges.
Well, and just to add on to Randy's point, during the height of the financial crisis, in the years that followed, it was the community banks and the regional banks that kept lending. And I think that's something that gets sort of masked over. Yes, there are fragilities in the system. We need to deal with the fragilities in the system, but there is a dynamism that has come out of this that, when I'm looking at where the backbone of the labor market has been the most resilient, now we're hitting that with a lot of fragility in the system, and that's not something.
I think we can agree that the two banking systems are hard to compare. Just because we've just pursued such entirely different approaches to how we will bank our countries,
Right.
And it's, I think,
And you guys
run
like
an
bankers
entrepreneurial
over
model.
Here. They don't like them in the
we
United
don't,
States so much.
and I just think it's a bit apples to oranges. And poor Daryl, he yelled out once, and he doesn't want to do it again. But this is really hard to listen to. Doug, what's the one thing you think policymakers should be focused on right now? Is it getting that soft landing right? Is the central bank the one that you'd be looking to?
So a lot of great points are already made. Just to pull a few of them together, I think one of the more important messages is in the 10 years before the pandemic, central banks had difficulty getting inflation up to 2%. We lived in a bizarre world where real interest rates were negative. That world is gone. Yep. I think over the next 10 years, they're going to have difficulty getting inflation down to 2%. That means a reset on interest rates. To Randy's point, yeah, we probably have gone a bit beyond the mark at this point. Rates will come a bit off in the years ahead, but I doubt they're going back to where they were before the pandemic.
Just one last, Randy. What is the motivation not to pause and see what has happened? In other words, the inflation fight is obviously perilous because we don't know how long the lag effect is now. We think it's shorter, but we don't know how short. Why not wait and see?
Well, I actually think the Fed will wait and see going forward now, that they felt that they were close to the terminal rate. And given the sort of constraints on financial conditions that have come from the banking issues in the United States right now, that gives them cover, if you will, to not send a kind of weak on inflation signal at the same time as pausing and saying, look, a lot of our work has been done by the constrained financial conditions.
It's the messaging that they're worried about. In other words, they
They're
could
worried
have
about
paused
the
before
messaging.
the last hike.
And they're worried about the lessons of history, which is that when the Fed has not been absolutely rigorous and sustained in addressing inflation, then you run the risk that inflation gets baked in and becomes much harder if inflationary expectations change, and that becomes a much harder task to address. They look at history, and they look at Arthur Burns, who was Nixon's chairman of the Fed, who was soft on inflation, given that we're already over time. Then they look at Paul Volcker, who is now viewed as a world historical figure, but who was absolutely vilified during his time at the Fed. And people were sending coffins in to the mail room and circling the Fed and chanting and protesting. And that's all forgotten. He got inflation under control, and he is a hero Arthur Burns, who retired lauded, our session has ended. Arthur Burns, who retired lauded, is a villain from top to bottom, from the person who fills the coffee machine to the chairman of the Fed, and they want that inset box in history to show them as heroes, not villains, and they know that the short-term perception of their actions is irrelevant to that.
All right, we're going to be really quick here because I can read. But are we optimistic? We're businesses. We just got the bank account survey. There's a kind of a growing fear and pessimism. Doug, this is kind of a yes or no situation here, but are we feeling optimistic or are we feeling pessimistic?
Medium term or short term? Medium term, for sure, optimistic.
Okay.
Absolutely.
Optimistic.
Medium-term optimistic, and I'm not going to talk about the near term.
Long term?
Long-term, I think there's a lot of potential, and so I hope we seize the day.
Oh, okay. Joe?
I'm always optimistic. I think we've dealt with challenges that are much greater than the ones that we're facing today. But I'd like to end where we started, and that's that, BMO, Eurasia Group, we got to do more of this, because for Canada to be successful, we have to be doing this, and we have to be doing it all the time.
Tom?
Very optimistic.
Excellent. Love that. That's a
Might
great,
as well get where you have the greatest opportunity.
that's right. We're going to end on a very optimistic note. Please join me in thanking our esteemed panel. Thank you very much.
Sir, very nice to see you again.
It was great to see you.